The S&P 500 has had a pretty volatile year so far. It's still up for the year, but ever since its peak in August, the major US stock market index is actually down quite a bit. Now, what if I were to tell you that below the hood of the S&P 500 benchmark, things have been pretty nasty? And this is what may give investors lots of attractive opportunities for long-term gains. So what do I mean by this? Let's find out and jump right into the video. Alright, hi there, my name is Rene, and as always I have prepared a little presentation that is going to walk us through today's video. So the title of the video is The S&P 500 is in a massive bear market, even though you don't see it. And I think this is what might give intelligent investors lots of opportunities. So let me just show you the table of contents. We're going to start by taking a look at the Magnificent Seven. I guess many of my viewers will be familiar with that terminology. We'll then take a look at the universe of small cap stocks and discuss whether this area of the market is getting quite tempting. We will then take a look at the market's overall valuation, discuss why the valuation of the market may be more attractive than it is reflected by the key metrics highlighted on major financial websites. And then finally, what do we do with all of the data that I'm going to share with you in this video? Of course, in fact, this video is going to be all about charts. I've prepared a ton of different charts that I think are super interesting if you are interested in the stock market. And so without further ado, let's have a look at a couple of charts regarding the Magnificent Seven. So maybe first of all, what are the Magnificent Seven? Maybe you haven't come across this term yet. Well, basically it refers to the 7 leading tech stocks that represent a majority of the S&P 500 index. I've actually listed the companies at the bottom of this slide. So we've got Meta Platforms, Amazon, Google, Tesla, Nvidia, Apple, and Microsoft. And as I just said, the S&P 500 index is quite heavily concentrated in these 7 names. Collectively, they actually make up 25% of the index as of today. And what you can see on screen right now is basically the performance of all of these Magnificent Seven members. We can see that Nvidia has been the best performing stock of the 7 year to date with a performance of 176%. We've got then Meta with a performance of 139% over the last couple of months. We've got Tesla, Amazon, Alphabet, Microsoft, and even the worst performing stock of this group, Apple, has been outperforming the market by quite a wide margin, because let's just compare the performance of the Magnificent Seven of the market as a whole. The market as a whole has delivered gains of 13.7% year to date. And considering that the Magnificent Seven represent a large component of the S&P 500 index, it doesn't surprise that they have been the main driver of the performance of the index this year. Here's another chart that basically shows that 82% of the entire gains of the S&P 500 in 2023 can be attributed to just 10 stocks. We can see that only 2% of the overall gains made by the S&P can be attributed to the remaining components of the index. And to put this into context, on this slide you can see how much of the overall performance of the index was driven by the top 10 stocks in any given year. And you can see that basically 2023 is quite an outlier, definitely reaching a level that is above the 32% median. So that would be the average contribution of the top 10 stocks in the S&P 500 in any given year. All right, with that being said, I think after looking at the large cap world and the mega cap stocks, we should shift our focus now to the smaller companies, so the small cap universe. So maybe for starters, what does small cap actually stand for? To be honest, I sometimes get confused with the different thresholds for the different market cap sizes, but you could define micro cap stocks as companies that are worth less than $250 million on publicly traded stock exchanges. We've got then small cap stocks, which are defined as companies with a market capitalization between $250 million and $2 billion. Next up on the list, we would have the mid cap stocks with a market cap above $2 billion, and finally the large cap stocks with $10 billion or more in market capitalization. And quite frankly, there could even be a fifth categorization here, the so-called mega cap stocks, which I think are defined as companies with a market capitalization of more than $200 billion. And all of the Magnificent Seven stocks would actually fall into this bucket. So let's have a look at a couple of charts again. What you can see here is the performance of the S&P 600. So this is a less commonly cited benchmark that can be used to measure the performance of small cap stocks. And what you can see here is that from its peak in early 23, at one point not too long ago, this index was actually down 18.77%. So not too far away from the definition of a bear market, which is a decline of 20% from a previous peak. Now, if we zoom out a little bit, we can see that over the last 5 years, this index has been almost flat. We saw some gains, but pretty much between 2018 and today, this index delivered only gains of 14.72%. Now, if we move on the spectrum to the mid-cap world, we can take a look at the S&P 400 index, which again is a benchmark to measure the performance of companies of a mid-cap market size. So what you can see here is that over almost 2.5 years, this index is also down, which stands in stark contrast to the overall performance of the S&P 500. Another chart. This one is focusing on the Russell 2000, another benchmark to consider the performance of smaller companies. Basically, you look at the Russell 3000 and then look at the 2000 smallest members of this index. And what we can see here is that adjusted for inflation, basically the index is trading at the same level it was trading at in 2015, which is quite a significant statistic in my opinion. All right, then we've got a chart from Charlie Bilello, who always, or I should say, who never disappoints, because he's always sharing very interesting insights. This chart here is comparing the performance of different S&P components. So we've got the S&P 50, the S&P 100, 500, the S&P equal weight index, and then we've got the S&P small cap index. And once again, this chart here is supporting what we were already showing with the previous charts. The world of small cap stocks has been performing pretty terribly. And just one last chart to back this up. This one here was shared by Kyle Creeve on Twitter. This one is showing that the ratio of the Russell 2000 to the Russell 1000 index is basically at a 22-year low. All right, if we take all of this into consideration, we can ask ourselves if the market is really overvalued. So let's first of all have a look at the overall valuation of the S&P 500 index based on a PE basis. So the PE, so the price to earnings ratio of the S&P 500, is as of today at a level of 24.15, which compared to the long-term average is high. So there may be many factors that are driving this long-term upward trend. As we can see, we are definitely above a level that could be considered normal in previous decades. Like, for example, businesses are more globalized today. Many of the US companies are of very high quality, earning high margins, maybe earning recurring revenues and so on and so forth. But I don't want to get into all of these details here. The point is, the S&P 500 is definitely trading at a somewhat elevated level compared to its historical average. If we then take a look at the Shiller PE ratio, which is basically trying to smooth out the earnings power of companies over the last 10 years, then we can see that the Shiller PE is basically trading at an even higher level and stands at a level of 29.43. And according to Guru Focus, the implied expected forward return based on this level is just 4.7% annually, which would actually underperform US long-term treasury bonds, at least on an annual basis, maybe not on a compounded basis. But the question I was asking is whether the market is really trading at a very high level. As we were just showing, the biggest components of the S&P 500 represent a significant portion of the overall index, and actually they represent close to 25% of the overall index. And if we consider the valuation of those biggest companies, obviously they will increase the PE ratio of the overall index because they carry such weight. If we exclude those mega tech companies with reasonably high valuations that are representing a majority of the index and focus on the small and mid-cap universe again, well, we can see the valuation of those alternative benchmarks here. So while the S&P 500 may be trading at a forward PE of 17, the S&P 400, again the mid-cap index, is trading at a forward PE multiple of 12.2, And the small cap index, the S&P 600, is trading at an even lower level at a forward PE of 11.3. And we're almost done with the data here. One last aspect that I wanted to share with you was also shared by Kyle Grieve on Twitter. He was referencing, I think it was a fund letter from Jason Donville and Jesse Gamble from Donville Kent Asset Management. And what they were basically doing is they were once again comparing the performance and valuation of large cap companies to small cap companies. So what you can see here is a basket of large cap stocks. And basically they were looking at their 2024 estimated revenue growth, their earnings growth. They were looking at the PE multiple based on a 2024 forward basis, and they were then bringing the two together, so the PE multiple and the expected growth, and they were forming a so-called EPS growth to PE multiple, which in a way could be considered an inverse of the Peter Lynch PEG ratio, which was dividing the PE ratio by the company's growth. And according to Peter Lynch, if a company was trading at a PEG ratio below 1, it could be considered undervalued. Yeah, but what Donville and Gamble were doing here is they were basically doing the opposite. So which means that the higher the EPS growth to PE ratio, the cheaper a group of stocks actually is. And what you can see here is that this basket of large cap stocks was trading at a EPS growth to price to earnings multiple of 0.61. So let us now compare this to a small cap basket. Basically what you can see here, I guess those are companies in their funds portfolio, is a basket of small cap stocks. And I think all of them are Canadian stocks, if I remember correctly. Now we now zoom in into the EPS growth to PE ratio. We can see that the average ratio for this group of stocks is actually significantly higher, like almost 10 times higher, probably 8 times higher. And it is standing at a ratio of 4.74. And so what they concluded is, quote unquote, we think this is the best way to illustrate the current state of the market. The large cap stocks have lower growth rates both for revenue and earnings, but trade at 26.5 times their earnings. The small caps, on the other hand, grow the top line and bottom line faster, and they trade at a cheaper multiple. So therein may lie an opportunity for you as an intelligent investor. Yeah, and that's basically the point of the video. What do you do with that data? Well, what I noted down on the next slide here is you have to go out and start hunting for attractively valued stocks that are trading at a below market multiple, but are likely going to deliver above market average growth rates. And this brings me to Robert Vinal, who recently shared like a great article to celebrate the 15-year anniversary of his Robert Vinal Business Owner Fund. And I just included a little excerpt from this write-up because I think it's so important. You might intellectually understand why the market as a whole may not be attractively valued right now, but that there are lots of opportunities in some pockets of the markets, especially in the small cap pockets of the markets. But a second element that is important to consider is, are you able to find the courage to actually buy stocks in this group of stocks? Because a significant component of successful investing is actually mastering your own psychology. And this is what Robert Vinal was addressing here. So let me just read to you what he was writing. There are two main failings resulting from emotional biases that an investor needs to eliminate: turning overly pessimistic when markets or investments are down, and turning overly optimistic when they are up. The single most important attribute in an investor is the ability to remain steadfast when the outlook temporarily looks bleak. And that's basically the point of this video. You have to find the courage to believe in the long-term prospect of smaller companies in the US, but also obviously this could be true for smaller companies all around the world. And if you can do that, if you can actually find these businesses, value them appropriately, come to a conclusion with regard to the outlook of those businesses, well, you have a very good chance of actually achieving very satisfying returns going forward, in my opinion. I've said it before in previous videos of mine. I've been investing for 7 years now, and I think the opportunity set that we are presented with right now might be the most attractive I have experienced over the last 7 years. So to reference Peter Lynch one more time to wrap it up here, you have to start turning over a lot of rocks. And this is what I was trying to show here with this image. If you want to learn how you do that, how you can find interesting opportunities and how you can identify interesting opportunities. So distinguish between poor investment opportunities and opportunities that are promising, satisfying, maybe even market-beating returns. I have a mentoring program for you that you might want to check out by looking at the website that I have linked in the description box below. As of now, we have 2 or maybe 3 spots left. So if you want to join this group of people who are basically on the same track as you are on their personal wealth building journey, reach out to me and I see you in one of my future videos.